Good morning. My name is Brett Skogstad, and this is a Capstone Coffee Conversation. I am joined by my colleague, Brian Felshaw. Brian, how are you today?
Good to be here, Brett. I'm
excited. We're not wearing the same color shirts. We're off to a good start. This is a Investment 101 conversation. A lot of different areas where someone can look to invest. And so we'll dive into some of those areas. And if you have any questions as they come up during the conversation, if you can go ahead and type those into the chat, we will try to get to some of those at the end of the conversation. Without further ado, you ready to get started?
Yeah, well, so like Brett said, we're going to talk about a couple different categories and just go over some basic definitions. So firstly, there's four main categories that where an investor can put their money to try to get some growth or to accomplish their financial goals. The first one, just plain old cash. And that just cash in hand, that includes checking accounts, savings accounts, money market accounts, and certificates of deposit. And all of those are designed to be little to no risk and just be available for spending. And consequently, they only really pay minuscule interest because the risk is so low. The second category is the most common one, and that is stock. And most of the time when we refer to the market, we're referring to the stock market. The third one is bonds, which we'll get to a little bit later. And the fourth one is hard assets, tangible assets. So things like real estate or precious metals like gold. So within those categories, there's lots of different sub areas, but the world of investing really boils down to those four main categories.
Okay, so let's talk about stocks for a second. I feel like when people think about buying a stock, they think they're at the casino or they're at the craps table and they can gain money, lose money, it can go either way. But what does it actually mean to buy stock, Brian?
So that's a great question. So stock represents a share of ownership in a company, or equity in a company, as it's commonly called. Sometimes stocks are called equities. So when you own a share of that company, you have an interest in that company's success, their overall growth, and their profitability. So just internalizing that definition alone changes the way an investor should look at their investments when it comes to stocks, right? Instead of trading in and out of stocks and trying to see which one's going to pop off in the short term, we're taking a ownership stake in a company. And if I'm a little bit younger and I have a little bit more time for my money to grow, that should guide me in how I should invest my money. I should probably kind of look towards companies that are younger and maybe are in more newer industries that have the chance to grow over the long term. If I'm a little older, that ownership definition will probably guide me towards older companies that have been tested over, they paid their dues and they've grown and they've established themselves. So that definition alone, understanding and internalizing that when I buy a stock, I'm owning a piece of that company, should help guide investors towards the way that they should invest.
Okay, let's change gears and talk about fixed income, more specifically bonds. We're still investing, but completely different situation. Talk about bonds a little bit.
Yeah, so a bond is different than ownership in a company. Instead of owning a piece of the company, you're loaning money to that company. So the same way that when you go to buy a home, the bank is going to give you a mortgage, they're going to pay you or you're going to pay them a fixed amount of interest over time in exchange for them lending you money. You're just the bank in this situation. So commonly bonds or loans are referred to as fixed income. And that is because the interest rate tends to be a fixed interest rate, doesn't fluctuate very much, as opposed to ownership in a company, which can fluctuate depending on how profitable it is. So for example, Microsoft says, we're going to pay you 3% over the course of 5 years for this loan if you give us a certain amount of money. That's a bond. And you would expect to charge Microsoft a different interest rate than you would charge a startup company, right? And that kind of helps determine what kind of bond you're going to get and what kind of interest rate you're going to get in exchange for that.
Let's talk about mutual funds, ETFs. There's not just one way to own a stock, but a different way. And so talk about mutual funds and ETFs and how they differ from just purchasing one individual stock.
So this is a great question because most investors out there in the world, including Capstone clients, we tend to invest our money into some kind of a fund. And a mutual fund or exchange traded fund, commonly referred to as ETFs, they work very similar. They're a pool of investors' money. And instead of owning just one company, the mutual fund will go out and buy many shares of many different companies. So it's a great way to have your money spread out over many different companies by just buying one share of a fund rather than buying one share of all these different kind of companies. Some mutual funds focus on as little as 30 companies. Some own as much as 1,000. And so like different companies serve different purposes for different investors, different kinds of mutual funds and exchange traded funds can fit different goals of investors as well.
Okay. So let's talk about risk. Purchasing an individual stock sounds like maybe it can be more risky than a mutual fund, since mutual funds could have up to 1,000 companies. In general, are stocks more risky to invest in than buying a fund or an ETF?
Well, again, it depends on the goal of the investor, right? So I like to think of it as us as advisors. I think of us as kind of like craftsmen. So we have different tools available to us to accomplish a goal depending on what the client would like to do. Some clients, an individual company, may fit the needs of what they're looking for. Most clients, though, their goals are accomplished by buying a basket of companies all at once through a mutual fund, rather than trying to pick which company is going to be best suited for their goals. It's an easy way to get what we call diversification. And diversification is a big piece of mitigating risk, right? Rather than having all our eggs in one basket, we have our eggs in many different baskets. The other note on risk is most people, when they ask the question, aren't stocks risky? What they're really asking is, can all of my money go all the way to zero? That's what they're really afraid of, right? If you have a mutual fund that has 1,000 different companies in it, it would take a astronomical scenario for every single one of those companies to go all the way to zero. So that's why we do like mutual funds and exchange traded funds so much, because they allow us to get that diversity and not have to worry about any one company's risk.
Right. You can still take on a lot of risk by investing in a fund, though, correct? In an ETF, right? Be pretty aggressive.
Right. So there are funds out there that focus on maybe just brand new emerging technologies, for instance, and maybe that's a little bit more risky than a company that focuses on, again, those older, tried and true companies. Yeah.
Okay. Very good. At this point, we will look to answer some questions that you guys may have. Go ahead and send those our way, and we'll look to get to some of those.
I have the first one.
Okay.
So with so many investments to choose from, how do you as advisors narrow down and choose the best stocks and funds for clients?
Good question. Yeah, I'll say a few words on that. A lot of it comes down to, we have a weekly investment meeting with Capstone every Thursday where we bounce ideas off one another, and we look to kind of review each fund that we have for our clients, and look into the current market environment and whether our investments make sense. And also, a lot of it comes down to individual clients' goals. Some people want to be more aggressive; they have a longer time horizon. Some clients might be more risk averse, or they don't have as much time to invest. And so we try to kind of look at each client independently and try to find the right investments that work for them.
Yeah. Again, I just go back to the craftsman analogy. I mean, we have a library of different tools that we've vetted over time through our systematic process and those meetings, and we apply them accordingly, depending on what needs to be done.
All right, here's another question. How often do you change the companies or funds you invest in?
Yeah, again, it kind of depends on the goal of the investment, the goal in the account. We use a tool called Rebalancing, and this allows us to go in and make tweaks from time to time in a portfolio. Sometimes we rebalance, a few times a year. Sometimes it might just be once a year. But Brian, can you kind of talk about rebalancing a little bit more?
Yeah. So in a nutshell, we tend to have, when we set out on a financial plan for a client, we'll have a certain percentage that we want each category of investments to make up a client's portfolio. And occasionally one of those categories will perform very well, and now that client has too much in that one category. So rebalancing is where we take a piece of those profits and go and place them in some of the other categories that maybe are undervalued. So, and this, again, this is done probably on average quarterly, but it depends on the goal of the client and what they're trying to accomplish. If there's no other questions, thank you for joining us for coffee with us. And we'd like to let you know that this is available on Facebook Live for viewing later. And if you have any other further questions, please contact your financial advisor.
Thank you very much.